In today's video, I'd like to talk about one of the most important financial calculations or ratios that you have whenever looking to take on new credit, get a loan for your house or an investment property that you have. I want to tell you first what it is, how to calculate it, and some tips on improving it. So let's get into what is your DTI ratio. Well, it stands for your debt to income ratio. Whenever you look at a bank or some kind of institution that is going to loan you money or open a credit line for you, they want to know how risky you are, so to speak, to one, pay that debt back, and two, to see if you can handle more debt, more payments each month, and they're looking out for your well-being from a financial standpoint as well. So your debt to income ratio, you simply take all your debt payments that you have each month and you divide that by your income. So let's say all your debt payments equal $2,000 a month, and let's say you make $6,000 a month. You would take $2,000 divided by $6,000 and you would get a percentage of 33% debt to income ratio, which is okay. And so something else to know when you're making this calculation, like you're not putting your utility payments and things like that in as part of this debt calculation. You're looking at things that are usually either revolving credit lines like credit card payments, your minimum credit card payments each month. If you have a mortgage, you would take that mortgage payment each month, car payments. If you rent your place where you live, you would put your rent payment instead. And in all of those fixed calculations, you would divide that into your gross monthly income and you would get the percentage. Now, the ideal percentage you want to be at is around 35%, some a little higher, some a little lower, depending what institution or bank you're dealing with. But if your income, your DTI is too high, call it 45, 50%, that's some big red flags to bankers and credit institutions that might say, hey, we don't know if you can handle this debt servicing or add more on top of your plate, and so you become more riskier to the bank. And so this is really important, specifically when you're going to buy your own home or you're buying an investment property. So whenever you're looking at this ratio, the obvious thing is the lower that debt ratio, the better you look to banks and folks that are going to lend you money or open up credit lines. So we went over what it is, how you get that ratio, and let me give you some tips. So first of all, I would highly encourage you, if you don't know what your ratio is, to go out after this video and find out, calculate it, see where your financial health standpoint is, and then the tips would be how to improve that. So there's really two ways you can improve it. One, you can go out and earn more income. That way you have more coming into your household, which would offset some of that debt payment. Or you can do work to lower your debt payments. So maybe you have a credit card, you might try to pay that thing off first, or you might try to make extra payments on your car or your mortgage, whatever that might be, whatever you can get to lower those notes down. You might pick up a side hustle or different things to generate more income. And so if you are able to do those two things simultaneously, either pick up more hours at work, get a side hustle, earn more income, then you could also lower some of that debt by paying off credit cards or other things that you can knock out pretty quickly. Then you're gonna put the levers in the right direction and your DTI will be a lower percentage. And then when you look to get a loan, buy an investment property, open up a new credit line, you will have more what they call buying power, which is a really, really great thing. So I hope you've enjoyed this video and found some value from it. Again, I would highly encourage you to go out and calculate your debt to income ratio after this video if you haven't done so yet. That way, especially when you're looking to get new credit lines or buy a house, you can go into that process not timid, but confident, knowing like, hey, my DTI is low, my income's good, my debt payments are nice, I know we should be able to get this loan because, and whenever you seem confident to a banker or kind of know what you're talking about, they also have more confidence in you and can talk you up to their board or whoever you have to deal with to get that loan or that credit line, whatever the case may be. So I appreciate you watching this video. Again, I hope you found value in it. Over the next couple videos, maybe I'll cut more things for personal finance and investing to help you along your financial journey. And so thanks again for watching. This video is a wrap. Bye for now.